Tariffs are taxes, but not just any taxes. They're specifically levied on goods that are imported from other countries. Imagine you're buying a product from abroad. A tariff is an extra cost added to that product by your government. They're slapped on goods we import. This means that when cargo ships bring in products from overseas, those items often come with an additional price tag thanks to tariffs. Think of China, Mexico, Canada. These are some of the countries we frequently trade with. When we import goods from these nations, tariffs can come into play. We buy their stuff, but with a tariff it gets pricier. So when you see a higher price tag on an imported item, part of that cost is likely due to tariffs. Why do governments do this? It's not just about making things more expensive. There are strategic reasons behind it. It's about protecting their own industries. By making imported goods more expensive, governments hope to encourage consumers to buy domestically produced items. If a foreign car is cheaper, slap a tariff on it. This makes the foreign car more expensive and less attractive to buyers. Now, the American-made car looks more attractive. This can help boost local industries and create jobs, but hold on, there's a catch. While tariffs can protect local jobs, they also have downsides. These tariffs, they hit your wallet. The extra costs are often passed down to consumers, meaning you end up paying more. That new TV, more expensive. Groceries, yep, those too. Everyday items can see price hikes because of tariffs. Tariffs are a balancing act, folks. Governments have to weigh the benefits of protecting local industries against the drawbacks of higher consumer prices, helping some industries, hurting others. While some sectors may thrive under tariff protection, others might struggle due to increased costs, and your wallet, often caught in the crossfire. The debate over tariffs is complex, with valid points on both sides, but one thing is clear. They have a direct impact on our daily lives and the economy. President Trump wasn't a fan of unfair trade deals. His solution? Tariffs, big ones. He hit China with a whopping 25% on billions worth of goods. Canada and Mexico? They got hit too. What happened? A trade war. Other countries retaliated with their own tariffs. It was a tit for tat, and guess what? Consumers felt the pinch. This trade war, it rattled markets, sparked uncertainty, and had everyone on edge. Remember that day the tariffs hit? The stock market sure does. It was a bloodbath. The Dow Jones, the S&P 500, the NASDAQ, all in the red. Investors panicked. They sold off stocks like there was no tomorrow. Certain sectors got slammed. Automakers? Forget about it. Tech companies? They took a beating too. Why the panic? Tariffs create uncertainty. Businesses hate uncertainty. And when businesses are uncertain, they hold back on spending and investing. That's bad news for the economy. Those tariffs have a nasty side effect: inflation. When tariffs make imported goods more expensive, guess what happens? The prices of everything else go up too. Think about it. That imported steel, it's now pricier. So what happens to the cost of building a car? It goes up, and who pays for that? You, the consumer. Inflation erodes your purchasing power. Your dollar just doesn't go as far, and that, my friends, is a real problem. The Fed's dilemma: rates and reactions. The Federal Reserve, or the Fed, is like the economy's doctor. They use interest rates to keep things in check. When inflation heats up, the Fed usually raises interest rates. This cools down the economy by making it more expensive to borrow money, but higher interest rates can also slow down economic growth. It's a delicate balancing act. The tariffs threw a wrench into the Fed's plans. They had to walk a tightrope trying to control inflation without causing a recession. Investing in uncertain times. Strategies for success. Market turmoil got you down? Don't panic. It's natural to feel anxious when you see red across the board, but remember, every market has its cycles. The key is to stay informed and not let fear drive your decisions. There are always opportunities for savvy investors. Even in the midst of uncertainty, there are sectors and stocks that perform well. It's about finding those hidden gems and making informed choices. Remember the old saying, buy low, sell high? This principle is timeless. Historical data shows that markets recover over time, and those who invest during downturns often see significant gains when the market rebounds. Well, market downturns can be a great time to buy stocks at bargain prices. When prices are low, it's an opportunity to acquire quality stocks at a discount. Think of it as a sale on your favorite brands. Look for companies with strong fundamentals that are well positioned to weather the storm. These are companies with solid balance sheets, consistent earnings, and a competitive edge in their industry. And don't forget about diversification. Spreading your investments across different asset classes can help mitigate risk. This way, if one sector takes a hit, others may still perform well. Don't put all your eggs in one basket. Diversifying your portfolio ensures that you're not overly exposed to any single investment. It's a strategy that can provide more stability in volatile times. Investing is a marathon, not a sprint. It's about long-term growth and staying the course, even when the road gets bumpy. Patience and persistence are key. Stay calm, do your research, and focus on the long term. By staying informed and making thoughtful decisions, you can navigate uncertain times and come out ahead. Investing wisely is about playing the long game. The job market winners and losers. Tariffs, they create winners and losers in the job market. Some industries benefit from protection. Remember those tariffs on imported steel? That's good news for American steel workers, but other industries suffer. Companies that rely on imported goods see their costs rise, and they may have to lay off workers. The trade war created a lot of uncertainty in the job market. Some workers saw their jobs disappear, while others found new opportunities. It was a mixed bag. Global trade war, a house of cards? President Trump's tariffs sent shockwaves through the global economy. Other countries retaliated and a trade war erupted. This tit-for-tat had everyone on edge. Businesses became cautious, investment slowed, and global growth stalled. The trade war highlighted the interconnectedness of the global economy. When one country sneezes, the rest of the world catches a cold. The road ahead, recovery or recession. As we navigate through these turbulent times, the question on everyone's mind is whether we are heading towards a recovery or slipping into a recession. The economic landscape is fraught with uncertainty, and the path ahead is anything but clear. The tariffs and the trade war created a lot of uncertainty. These economic policies have had far-reaching impacts, affecting not just the countries directly involved, but also the global market. Businesses are grappling with new regulations, and consumers are feeling the pinch as prices fluctuate. The ripple effects of these decisions are still being felt, and their long-term consequences remain to be seen. What does the future hold? This is the million-dollar question that economists, business leaders, and policymakers are trying to answer. Predictions vary widely, with some experts forecasting a swift recovery while others warn of a prolonged downturn. The stock market, often seen as a barometer of economic health, has been volatile, reflecting the uncertainty that permeates the current climate. It's hard to say for sure. The economic indicators are mixed, and the data can be interpreted in multiple ways. Some sectors are showing signs of resilience, while others are struggling to stay afloat. The empty boardrooms and uncertain expressions on the faces of business leaders tell a story of caution and apprehension. Some experts predict a recovery. They point to positive trends such as increased consumer spending, a rebound in manufacturing, and government stimulus measures as signs that the economy is on the mend. These optimists believe that the worst is behind us and that we are on the road to recovery. They argue that the tariffs will eventually lead to more American jobs and a stronger economy. The idea is that by protecting domestic industries, the tariffs will encourage companies to invest in local production, thereby creating jobs and boosting economic growth. However, this view is not universally accepted. Others fear a recession. They worry that the tariffs will stifle global trade, increase prices, and slow economic growth. The higher costs of imported goods could lead to inflation, reducing consumers' purchasing power and potentially triggering a recession. The sight of shipping containers piling up at ports and the rising prices in grocery stores are cause for concern. The truth is, nobody knows for sure what the future holds. The economy is influenced by a myriad of factors, many of which are unpredictable. From geopolitical tensions to technological advancements, the variables at play make it incredibly challenging to forecast with any degree of certainty. Business analysts and financial experts can offer educated guesses, but the reality is that the future remains uncertain. The economy is a complex system, and predicting the future is a fool's errand. The interconnectedness of global markets means that a change in one part of the world can have ripple effects elsewhere. Economists often use models and simulations to try and predict outcomes, but these are based on assumptions that may not hold true. The image of an economist shaking their head or a crystal ball with stock market symbols underscores the difficulty of making accurate predictions. Stay informed, stay vigilant, and be prepared for anything. In these uncertain times, the best course of action is to stay informed about the latest developments, remain vigilant in monitoring economic indicators, and be prepared to adapt to changing circumstances. Whether we are heading towards recovery or recession, being proactive and staying ahead of the curve will help navigate the challenges that lie ahead.